Hey there, and welcome to this Business Basics Hub Explainer. Really quick before we dive in, just to note that this is for general educational purposes only and is not legal, tax, or financial advice. Laws and requirements vary by state and your individual situation, so always consider consulting a qualified professional for guidance specific to your business.
Today, we're going to break down exactly what a business partnership actually is, how it works behind the scenes, and the absolute safest way to build one from the ground up. If you've ever thought about teaming up with someone to start a company, this explainer is exactly what you need to check out before you take the leap.
Here is our roadmap for today's explainer. 1. The definition. 2. Why it matters. 3. Steps to create one. And 4. Common beginner mistakes. Let's get right into it. Section 1. The definition. So what exactly is a partnership?
At its core, a partnership forms anytime two or more people agree to go into business together for profit. Now, what's totally wild here is just how informally this can happen. You might assume you need a mountain of paperwork, right? Well, surprisingly, courts can recognize a partnership based entirely on your behavior. Yeah, even if you never sign a single piece of paper. If you and a friend are actively running a little side hustle together and splitting the cash, you might have just accidentally become legal partners. And here's the kicker. If you don't have your own written agreement, your state's default rules just automatically take over. And trust me, those default rules might not actually be what you want at all.
There are two really common types of partnerships you need to wrap your head around. On the left side, we have a general partnership. This happens automatically when you start doing business. But here's the huge catch. It comes with unlimited personal liability for all partners. That means your personal savings and your house could be on the line. That is incredibly risky. Now, on the right side, we've got an LLC partnership. This one doesn't happen automatically. It requires filing some paperwork with your state. But here is why it is an absolute game changer. It gives all the members limited personal liability. It builds a legal wall around your personal stuff. You'll notice both have pass-through taxation, which just means the business itself doesn't pay a corporate income tax. The profits pass straight through to your personal tax returns. So bottom line, while a general partnership is automatic, most beginners are so much better off taking the time to form an LLC partnership to protect their personal assets if the business ever fails.
Moving on to Section 2, Why It Matters. The good and the bad.
Understanding these trade-offs is absolutely crucial before you dive in. The sheer beauty of a partnership is that you get to pool your money together, which really lowers your individual startup costs. You can also combine complementary skills. Maybe you are totally fantastic at sales, and your partner is an absolute genius at daily operations. Plus, you get that simple pass-through taxation we just talked about. But we really have to look at the bad stuff too. The terrifying reality of a basic general partnership is that unlimited personal liability. Plus, you obviously have to share the profits. But honestly, the worst part? You are fully legally responsible for any bad decisions your partner makes. I mean it. If your partner signs a terrible contract completely behind your back, you are personally on the hook for the consequences. No way around it.
All right, Section 3. Steps to create one. Your action plan.
If you are ready to make this happen, these first 5 steps are all about planning and building a rock-solid foundation. Step 1, and I cannot stress this enough, you must thoroughly evaluate your partner. Seriously, do not rush this. Step 2, pick a structure. Like we said, an LLC is usually your best bet to limit that liability. Step 3, choose a business name and make sure it's actually available. Step 4, write up your partnership agreement. Think of this as your essential business prenup. This document decides exactly how profits are split and who makes the big decisions. And Step 5, officially register with your state and grab any local licenses you might need to operate.
To finish setting everything up, we have the day-to-day operational steps. Step 6, you're going to need an EIN. That's an IRS tax number, and you need it to open a dedicated business bank account. Huge rule here. Never, ever mix your personal and business money. Step 7, set up a clean, organized bookkeeping system from day one. Step 8, write out a solid business plan so you are both moving in the exact same direction. And finally, Step 9, get some business insurance. This protects you against those totally unexpected disasters and helps cover risks that your business structure alone might not fully shield you from.
Section 4. Common beginner mistakes. What to avoid.
Even with a super clear plan, beginners fall into these predictable traps all the time. The absolute biggest mistake you can make starts with operating without a written agreement to handle disputes. Doing business on a handshake is just asking for a disaster down the road. Another huge mistake is teaming up purely because you are friends or family. You need complementary business skills to succeed, not just a shared history. You also cannot fail to plan for what happens if one of you wants out. You've got to sit down and discuss those worst-case scenarios and buyout terms super early on. Also, mixing your personal and business finances in one single bank account, that is going to cause a massive tax headache. And finally, just ignoring personal liability risks by settling for a basic general partnership instead of legally protecting yourself.
I want to leave you with this incredibly powerful thought from our sources today. No partnership agreement, no matter how well drafted, can compensate for choosing the wrong partner. At the end of the day, you are literally placing your personal financial future right into someone else's hands. So you have to ask yourself, have you truly vetted the person sitting across from you? Do they handle stress well? Are they financially stable? Trust has to be based on demonstrated behavior. Take the time to get this right.
As a quick reminder, this explainer is for general educational purposes only and is not legal, tax, or financial advice. Laws really do vary by state, so definitely consider consulting a professional. But hey, if you found this explainer helpful and you want more simple, no-fluff business guidance, please hit that like button, subscribe to the Business Basics Hub channel, and turn on the notification bell so you don't miss our next explainer. Feel free to share this with a friend who is starting a business too. Thanks so much for watching, and we'll see you next time.